Okay, so now we're going to look at our income statement. So the balance sheet gave us sort of an idea of what's going on at a moment in time. And then our income statement tells us what's happened in the company over a period of time. And so the income statement is comes up a lot. Sometimes it's called like the P&L or profit and loss statement. So if you hear that, they're talking about the same thing. So if you're at work and they're talking about P&L, they're talking about the income statement, and tells us about how profitable a firm has been over a certain reporting period. So a lot of times when we look at those annual financial reports, it'll show us the income statement over a year, or sometimes we might see it quarterly, so each quarter. But really, we'll probably see this reported maybe for the year for a company. So it's going to tell us about any revenues or sales. So this is income that the company has generated, right? And then also any expenses. So things that they had to pay for in order to create those sales. So this could include things like the cost of products and services, that's the cost of goods that they're selling, any assets they've used, so depreciation, all sorts of things. And so when we take all the revenues or the income that's been generated and we subtract all of the expenses, so everything we paid to make that income, then we come up with this idea of our net income or our profits. So net income is a interesting one because it goes by a lot of names. So net income, sometimes it's called just profits. Sometimes it's called income. Sometimes it's called the bottom line. You know, how's the bottom line? The bottom line is good. The bottom line is positive. That's what they're talking about. Or if we're talking about earnings, that's what we're talking about. So earnings or earnings, profits after tax, all of those things are our net income. And so that's an important number that a lot of people look at to try to understand the health of a company. Like, how's it doing? Is it making profits? Is it profitable? What's going on? And so for us, it's good to understand this number, what it means. And then later, when we look at our statement of cash flows, we'll see how to adjust this number to make sure that we're also looking at all of the current cash that we have coming in or going out of the company. But for now, we'll just look at the net income on the income statement alone. So this is another important relationship to keep in mind. So your net income, that's just your profits, which is take all the money that you've made, your income, your sales, your revenues, subtract all the expenses. So everything it costs, you know, you had to pay wages, you have to pay taxes, you have to pay all sorts of things. After you pay all those things, whatever is left over is your profits. So here's just a quick example of how an income statement might look. So let's say for the year 2014, it starts off with your revenues at the top. So these are the sales or the income generated by this company right here. And then from there, we take out a whole bunch of expenses. So one is cost of goods sold. So how much did we have to pay for all the things we needed in order to generate those revenues? So there's some costs. Maybe there's some selling admin expenses. Another important expense is this idea of depreciation, and we're going to look at that in a little more detail in a second. Did we have to pay any interest on any money we borrowed? And then, of course, our taxes. And so once we take our sales, subtract all those different expenses, we end up right here with our final net income for this company. And when it's positive, then we have a gain, right? We're profitable. If this number comes out negative, then we see a loss. Okay, something I want to just talk about quick because it's going to come up again is this concept of depreciation. So when you're reading through the text and when you're going through your note studying, just make sure you're really comfortable with what's going on here with depreciation. So depreciation is when we take a physical asset, say it's a plant or machinery. So say even you can think of it as maybe it's a car or a truck, right? And we write it off over its lifetime. So we take something and we make it worth less over time. So I like to, sometimes I think of it as, you know, when you buy a brand new car, right? So if I bought a car today and I paid $100,000, well, I'm buying a really nice car, guys. Okay, so I'm gonna buy a nice car. I wish, let's pretend this is an example. So let's say I bought a car today for $100,000. In 1 year or in 2 years, as I use this car, as I kind of put wear and tear on the car gets older, maybe the engine's getting older or the tires are wearing out, whatever those things are. As that car gets used up and gets older, the technology gets outdated. It slowly over time starts to become worth less money, right? So maybe then it's worth 90,000 and then 80,000. And it just becomes, if I went to sell it, worth less. So a way for us to take care of that in accounting is to use something called depreciation. So it takes into consideration this idea that when we're using machines, when we're using different types of equipment, when we're using items, they get worn out over time. And so we can put that into our accounting statements by using depreciation to take that book value of the asset and make it smaller over time. Now, in accounting, everything balances somewhere at some point. So if I'm taking this asset and making it smaller, worth less, that $10,000, so it went from 100 to 90,000, this $10,000 has to be accounted for somewhere, right? We can't just make it disappear. We have to make sure we pay attention to where all these numbers are going. And that $10,000 in this case each year, that's what we call depreciation. And it gets written in an account called your depreciation account. And we call it a depreciation expense that we can take in our financial statements. Okay, so depreciation just considers that things essentially wear out over time or become worth less over time. And so we can adjust for that in our accounting statements by making those items worth a smaller amount over time. And that amount that we decrease them by, that's our depreciation amount. Sounds like a lot of accounting, right? But the reason we're concerned with this is because this depreciation expense comes out of our income statement, right? So if we were looking at that income statement we had before, let me bring it up for a sec. Right here, we had a number called depreciation, right? And we counted it as an expense, right? It's because it's taking, and so this number, when we take it out of our net income or our revenues, makes it look smaller over time. We take it as an expense. And so that's why we are concerned about what this number means and how this number is being used, okay? And the reason for this is because when we're thinking about this from a finance perspective, this is an expense, but it's not a cash expense. So I don't ever write a check for $83.1 million and send it out to depreciation. There's no money that actually leaves my company. So even though it looks like I have a revenue number, I subtract this expense from my revenues. So my overall income will get smaller. There's not actually any money physically leaving the company. And so later we need to make some adjustments for that depreciation number. So it's important to understand where that number is coming from and what it means. And it's also important to understand how that number is being calculated, because it can make our income statement look a bit different depending how much depreciation we take. So one way to look at this is, let's say a company, let's even simplify this a little bit. And let's say this is the same company, but in this case, for their depreciation, they used a technique that said each year we're going to take $20,000 in depreciation. So we have a $100,000 asset, and every year we're going to decrease its value by $20,000. So that's one way that they're going to take their depreciation. Another way they could do it, because there's different methods, is they could say, okay, instead let's say the first year we're going to take a big amount. We're going to take $40,000 in depreciation. When I drive my nice car off the lot, it's going to depreciate significantly, right? They always say that your car is going to be worth so much less as soon as you drive it off the lot. So let's take that into account. So let's say year 1, the depreciation is $40,000, year 2, 24, year 3, 14, 4, 10,800, and then 10,800. So what I'm showing you here is there's 2 methods that we could possibly use of many to calculate depreciation. And in one case, we would take out $20,000 every year. And in the other case, we would take out 40, then 24, then 14, and so on until we wrote off that whole item. Okay, why is this interesting, right? It's interesting because if we wanted to see what this looks like on our income statement, and so we can see that, remember that this is the same company with the same sales and the same cost of goods sold, the same everything. The only difference is they have that $100,000 item and they depreciated it in 2 different ways. So in the first way, they depreciated $20,000, and in the second way, they did $40,000. Okay, and so I just want to show you what that could look like actually on our income statement from there. So when we take our sales and we subtract our cost of goods sold and our selling expenses, we end up with this earnings before interest, tax, depreciation, and amortization. So far, nothing interesting really changed. In both cases, the company has $65,000 in earnings before interest, tax, depreciation, and amortization. Sometimes you'll hear it called like EBITDA. That's what they're talking about. From there, we're going to subtract this depreciation expense. So our earnings before interest and tax, in this case, when we take out our $20,000, we have $45,000 in earnings before interest and tax. And then in this other side, we have $25,000. Okay. The interest they pay in each case is the same. Remember, this is the same company, so whatever money they borrow, they're paying the same interest. But our earnings before tax is going to look different. So here we subtracted $20,000. We took out our interest, and we ended up with earnings before tax of $40,000. When we want to calculate the amount of tax we're paying, we take the tax rate, multiply it by that earnings, and we find out that in this case, on this earnings, we pay $3,200 in tax, and we end up with a net income here of $36,800. Okay. On the other hand, if we took a bigger depreciation expense, you can see that our earnings before tax is smaller, which means we get to pay smaller amount of taxes, right? Because we're paying 8% of $20,000 here, which in turn still results with us having a lower net income. Okay, so this can be a little bit deceiving. Our net income here looks a lot better when we use this straight line or that first depreciation technique, right? Because we subtracted a smaller amount from our overall net income. We subtract $20,000, we calculate our taxes, it looks like we have a higher net income, $36,800. But if we look at this closely, you can see that in this case, though, you actually pay more taxes than you had to pay before, right? When we use a bigger depreciation number, it decreases the earnings that we have to pay taxes on. So using a bigger number here, let us pay less taxes here. And so it doesn't look great if you're an investor because you think the net income is smaller. But really, it was just a handy tool here that helped this company to pay a smaller amount of taxes, because the big thing here is this is not actually money that left the company, right? So even though we take it and subtract it from our revenues, it didn't go anywhere. So this company still has $40,000. So they have the $18,400 plus the $40,000, because that depreciation was a non-cash expense. And on this side, they have that $36,800 plus they still have $20,000. So if we look at these closely, on this side, this number is going to be bigger than this one. And that's because overall, you got to pay less taxes by taking more depreciation. So this is why sometimes companies will prepare sort of two sets of financial statements, one for taxes and one to show investors. Because when investors are looking quick, they're not calculating how much taxes did they pay, what's going on with depreciation. A lot of times they're looking at, okay, what's the net income, what were the profits? And so when I'm reporting to investors, I might want to use this depreciation technique because it looks like I have a higher net income. But then when I actually go to pay taxes, I might want to use this one because I get to pay less taxes overall, right? So, but here's why it's important to make sure that you kind of at least have a general idea of what's going on with that depreciation. So depreciation lets companies write down the value of an asset over time, right? So make it smaller over time. When it comes to our income statement, it gets treated as an expense. And so that depreciation expense decreases our earnings before interest and tax. So when we make that number smaller, we're going to pay smaller amount of taxes, but our net income will also look smaller. And so it's just good to keep those things in mind, especially because this is the trickiest one. So this is the most important to remember. Depreciation is not a cash flow. There's no money actually leaving your company. So there's no person I write a check to say, here, dear Mr. Depreciation, take $20,000. Doesn't happen. Doesn't go anywhere. So we still have to remember that that money is still ours as well. Next slide we have here just kind of breaks down those items that we had on the actual income statement, just to give us a better idea of how they all kind of work together or flow together. And this will come in super handy when we do the next sort of income statement example together. So it's good to make sure that you kind of take a look at and are comfortable with all these different components of the income statement. So your earnings before interest, tax, depreciation, and amortization, that's your money that we get from selling goods and services minus the cost of providing them. And so if we were looking up here on an actual income statement, maybe an actual income statement, you can see your EBITDA, your earnings here, is your net sales minus your cost of goods sold minus those selling and admin expenses. And then your earning before interest and tax. And then your earning before interest and tax, EBIT, is your EBITDA minus depreciation and amortization. And so sometimes I think it's super handy the way these work out because you have your EBITDA, EBITDA, earnings before interest, tax, depreciation, and amortization. Then when you subtract depreciation and amortization, you just kind of take those off and you're left with your earnings before interest and tax. And then minus any interest expense, so EBIT minus interest, take out the interest, you're left with EBT. And this is your taxable income. So when we want to figure out taxes, it's going to be your EBT, the earnings before tax, times your tax rate. Okay, and your net income is your earnings here before tax minus any taxes. Okay, so we'll do one income statement example together just to see how this all kind of flows and works together. Okay, so I'm going to set this up like we did before in Excel, but I'm going to show you how we can rearrange and solve for a different piece of this income statement. So we're going to need to it's going to help us to be really comfortable with how all these components fit together on the income statement. Okay, so this is the example that we had in the slides, and I'm going to show you guys how to solve it, and we're going to use Excel to actually solve this. So yeah, it's going to give us a good way to practice how to move these numbers around on the income statement. So the first thing we do is we're given a list of information here about this company, and we're told that we don't know what the depreciation and amortization expense is, and it wants it to solve for this. So that's what we're trying to solve for in this problem. So whenever you have problems like this, the best thing to do is start off by listing the information we know. And so what I've done here is I've set up sort of these rows or this column, I've set this column up in such a way that the rows here indicate each of the sort of different items that we could have on that income statement. So we have our revenues, it would be minus costs, is going to equal our earnings before interest, tax, depreciation, and amortization. Then we would subtract the depreciation and amortization, get our earnings before interest and tax, minus interest gives us earnings before tax, minus tax, and then we'll get our net income at the very end. Okay, so let's fill in the actual information we know, and then we can try to work our way around this to figure out if we can get to what that depreciation and amortization number is. So this is the one we want to solve. Okay, let's try. Let's see what we've got. So the first thing we have here is this earnings before interest, tax, depreciation, and amortization. And we're told it's 35 million. So I'm going to take that 35 million and I'm going to put it right in there. The next thing we have is net income. So net income is going to be 9 million. And our interest expense is 5 million. Okay. Okay, and so what we've got to figure out next here is what's this depreciation and amortization number? So it doesn't seem like we have that much information to go by. So we got to kind of do a little bit of detective work to figure out how are we going to get there. And one way to do that is to make use of those sort of formulas that we know that can go with this income statement, right? So we know that, for example, let's write them out here so we have them. Our earnings before interest, tax, depreciation, and amortization is equal to our revenues minus our costs, right? We have that from our income statement. We know that our earnings before interest and tax is equal to this one, EBITDA, minus our depreciation and amortization. Okay. We know earnings before tax is going to be equal to our EBIT minus tax or minus interest. And then we also know that, what else do we know? We know that our net income is equal to our earnings before tax minus our taxes. Okay, so that gets us started. I think another good formula to keep in here as well is that our taxes are equal to our earnings before tax times the tax rate. Okay. And so when we look at this sort of list of formulas that we've got, this is where our algebra practice comes in a little bit. So you can see this can be a useful tool when we use our math for some of these problems. Okay, so what we can do is we know in this case, what I'm going to do to solve this, I'm going to show you how I would do it, is I would start off with these two equations right here. Make them yellow or green. Okay. Okay, and I'm going to make use of those in order to solve for that earnings before tax. I'll show you how I do that. Okay, so here I know net income is 9 million and I know my tax rate is 25%. It's given in the question. So if I can combine these two equations, I would have net income, earnings before tax, and tax rate, so that I would just have one thing left to solve for. I'm going to show you what I mean by that. So I would have my net income. So net income equals EBT minus taxes. And I also know that taxes equals EBT times the tax rate. So if I had net income, okay, so this is where we can use a little bit of substitution. I know that taxes is equal to EBT times the tax rate. So what I'm going to do is in this net income equals EBT minus taxes, I'm going to replace this taxes with this EBT times the tax rate. So then I'll get something like this, net income Okay, so now I have net income is earnings before tax minus EBT times tax rate. And the reason I can do that is because I know that taxes here is equal to this all multiplied together. Okay, so now I have net income, EBT, tax rate in one equation. And I want to solve for that earnings before tax because I know net income, it's given to me, and I know the tax rate. So that's the one I want to solve for next, because then I can keep working backwards through this income statement. Okay. And so now here we're going to use a couple extra tricks from our algebra, right? Okay, so we can do net income is going to be equal to, the nice thing here is when we have EBT like this in two places, we can factor it out. So that's a common factor. So if we took that EBT out, then we could do times 1 minus the tax rate. Okay, so our net income is earnings before tax times 1 minus the tax rate. So there's a multiplication in there. And now it's even better. So now I know net income, I know the tax rate, and I still need to solve for EBT. But by arranging this formula, by factoring out that EBT and putting it alone here, I got it as one single variable. So now it's going to be a little easier to solve for. So now I'm going to get that EBT all by itself, I need to take this net income over here. And I need to get rid of this piece here. And I can do that by moving it to the other side of the equal sign. So remember, whenever we move something to the other side of the equal sign, then we do the opposite operation. So if it's multiplied on this side, we're going to divide it on the other side. So here it's times 1 minus the tax rate. So when I move it over here, it's going to be divided by 1 minus the tax rate. So practice moving this around and make sure you're pretty comfy with it. If you have questions, you can always send me an email and hopefully I can help you out. So that's how we can get to the actual earnings before tax. So our earnings before tax is going to be net income divided by 1 minus the tax rate. So in Excel, I can do that by typing it into here, right? So here, my EBT is going to equal, I'm going to take net income right here, equals net income divided by, open parentheses, 1 minus the tax rate, which is 25%. And then I'm going to close up those parentheses. So in Excel, whenever we're doing these kinds of things, you can see that this is just as if we would type it into a calculator. We're going to just type it into this cell. So equals net income, B21. It highlights it blue for us there so we can make sure we have the right one. Divided by 1 minus B8, which for us is the tax rate. And that gives us our earnings before tax. Okay, so we can fill that in now on our income statement. So now we know the EBT here equals 12 billion. Okay, so we're still though need to keep working back a bit, right? Because we've got one more number but we still have to keep working back. And our goal in this is to be able to get to this depreciation and amortization number. That's where we're trying to get. So I have now a few things. I have EBT interest. If I work back a little bit further, I could probably get my EBIT now, right? My earnings before interest and tax. So here, if I have EBT and I have interest, which I do, I have interest, I have EBT, I can solve for that earnings before interest and tax. Okay, so if I was doing it, it would be like EBT equals EBIT minus interest. Double check. Earnings before tax, I know what it is. Yes. Earnings before interest and tax, no. I don't know yet. And interest, yes, I know what that number is. So now I have two numbers and I need to solve for this third one. So I can do that. I can figure this out. So here, if I was looking at what that would look like, and I wanted to type it out, it would be my earnings before tax. I would take this number right here. So 12 million. Right? And that's going to be equal to earnings before interest and tax minus interest. And interest for me is $5 million. So it looks like this. So this equation is the same thing. So this equation right here, EBT equals earnings before interest and tax minus interest. And now I want to solve for that actual EBIT. Okay. So we're going to do like we've been doing so far. We're going to try to get this EBIT alone. And to do that, I'm going to take this 5 million and move it to the other side of the equal sign so that this one here will be all by itself. And then I can solve for it. And so whenever we move something across the equal sign, we have to do the opposite, right? So here, if we're subtracting 5 million, when we move it over here, we want to add 5 million. So it'll look something like this, right? Okay, so if I move it over, it'll become 12 million plus 5 million is going to equal that earnings before interest and tax. So to calculate it, I'll do equals here, 12 million plus 5 million. So 17 million. So now I have a number for earnings before interest and tax. Okay. And if I'm looking at it backwards here on my sheet, if I want that EBIT number, remember EBIT is equal to that 12 million plus 5 million equals 12 million plus 5 million. We're almost there, I promise. Okay, so now we've got our earnings before interest and tax. So finally we're just about there, because look at, we've got the one before it and the one after, and we just want to figure out what that depreciation and amortization is. So we're taking earnings before interest and tax minus some number here, depreciation and amortization, is going to equal 17 million. Okay, we have a formula if we want that we can look at for this. So the formula looks something like this. Earnings before interest and tax equals EBITDA minus depreciation and amortization. Okay, so if we're looking at this, right, we've got EBIT. Yes, we just solved it. We have earnings before interest, tax, depreciation, amortization given to us in the question. So we have EBIT and then EBITDA here. And we want to solve for this one. And so for us, we can plug these numbers in. So EBIT is our 17, 1 million. Okay. It's going to be equal to this one, 35 million, EBITDA, 35 million. Minus depreciation and amortization. Okay. So we need to get this depreciation and amortization alone. And also I'd like to make it positive. So if it's negative on this side of the equation and I move it over here, it'll make it positive, right? So if I was looking at what that would look like, it would end up looking something like this. If I move just this one over to this side, I would have 17 million, right? Plus depreciation and amortization. Right? And then on this side, it would say equals 35 million. Okay, so if I'm looking at this equation and I want to move this depreciation and amortization over to the other side of the equation, I'm going to take it from a negative and make it positive. So when I move it over, it'll start to look something like this. 17 million plus depreciation and amortization equals 35 million. Now I still haven't solved for the depreciation part. So I need to take now this number and move it over here so that this one's all by itself. I like it because on this side it's positive, so it makes it a lot easier to interpret it, right? So let's see what happens when we do that. Okay, so now we've got to a place where we can solve for that depreciation and amortization. I took that 17 million, moved it to the other side of the equal sign. So here it's positive 17 million. When I move it across, it becomes negative. So that's how I got here. I have depreciation and amortization equals 35 million minus 17 million. And so my final answer, I can solve for that now. So now I can solve for that by typing in the numbers I need, right? So here, just like a calculator equals, I'm going to take 35 million minus 17 million. Okay, and so then it gives me this nice number here for my depreciation and amortization, and that's the solution. So we're like, oh, we finally got there. We did. Good job. Okay. 18 million. And so if we were back up here, just in case you wanted, you could put it inside of here, right? So EBITDA, right? We said minus EBIT gives us our depreciation and amortization amount. So it can get a little tricky when we're practicing some of the problems from the book and from class, because it's not just a matter of filling in the numbers we need on the income statement. Now we're practicing moving around on that statement and solving for different pieces of it. So make sure you're really comfortable with the algebra part where you have to move things around in an equation. If you have questions about it, feel free to contact me and let me know. But definitely practice that. And I think there's some practice in the homework that'll also help you practice doing those types of problems. So the next thing we're going to look at here quick is this idea of our statement of retained earnings. So it's an important one to have an idea of what's going on. The way I like to introduce this kind of concept in our finance class is, at the end of the day, the company has some kind of earnings, right? They've got some kind of earnings or net income. Same thing, okay? So they've made some money. So they took all their revenues minus costs and expenses, and they're left with some net income. There's two main things that they'll do with it. One is that they'll pay dividends to shareholders. Okay, so that means they take part of this profit, part of this earnings, and they take some of those dollars and they give them to the owners of the company. So they take some income that's left and they pay it out to the owners of the company. And when we have shareholders, when we pay out money from our earnings to our shareholders, those are called dividend payments. So it'll say, for every stock that you own in this company, for every share of stock that you own in this company, maybe you're going to get a $1 dividend. We're going to take some of these earnings and share them amongst all the people who own the company. And that payout of earnings to owners is called a dividend payment. The other thing they can do is they can keep the money in the company. So I can use some of those earnings to invest in new projects in the future. Maybe I can use some of those earnings to keep it in the company, and in a couple years, if I need to buy a new building, I'll have it there, right? So they can either pay it to the owners, and that's called a dividend payment, or they can keep it in the company, and that's what we call the retained earnings. Okay. And so when we're talking about the statement of retained earnings, it's telling us over time what adjustments have been made to these shareholders' equity. So that retained earnings balance, has it increased or decreased over time, right? So over the last year, has this number of retained earnings that we have gone up or down? So has this number gotten bigger or smaller? Okay. And so that's what our statement of retained earnings is all about. Okay. And so there's two main events that can contribute to whether those retained earnings are increasing or decreasing. So one is if you have a net income or a net loss, that can impact the retained earnings. And two is if the firm pays a cash dividend. And that's because if you think about it, if your income is decreasing, then you have less money that you can keep in the firm. If you pay a dividend, then there's less money that you can keep in the firm. And that kind of comes back to, I know I keep showing you this, but it comes back to this whole kind of relationship right here, right? So if you think of the story behind it, if this number is small or negative, it's going to make this number smaller too. If you pay more money as a dividend, then you'll have less money to keep in the firm. And so that's why our net income and the amount of dividends we paid are the two main activities or the two main factors that can impact how much retained earnings we have in this company. Okay, so let's take a look at an example of this, right? So here we have this company, Diaz Manufacturing, and we've got some information. We know that their balance of retained earnings in December 2013 was negative $50.7 million. They've got an increase in net income of $118.5 million. They didn't pay any dividends, and so their balance of retained earnings was $67.8 million. So where do these numbers actually come from? And so for us, when we're looking at this, the statement of retained earnings also kind of links together two different statements in our financial statement. Our actual balance in retained earnings is going to come from our balance sheet. So when we're looking at our balance sheet over here under shareholders' equity, there's something called retained earnings, right? And so that's how we can figure out what the actual balance in retained earnings is. And then our income statement tells us, of course, the overall net income, as well as any dividends we might have paid. In our case, the common stock dividend here was 0. And so then if we want to figure out any change or adjustment to our overall retained earnings from 2013 to 2014, we start off with that 2013 retained earnings. That's what we did over here. We started off with those 2013 retained earnings. And then we added our income that we made, 118.5. That's how much income we made in 2014. We didn't pay any dividends. This was 0. And so overall, our retained earnings balance is going to be 67.8 million. And so the final thing we're going to talk about here is the statement of cash flows. Okay. This one's pretty important, and it's important enough that when you get to lab module 2, which is coming up soon for you, 2, it's all on statement of cash flows. So it's going to make you categorize items and create a statement of cash flow. So it'll get into really good detail of an example of how to put together this statement of cash flows. But just remember, for us, it's nice because it's going to actually summarize for us the cash outflows and inflows over a year. So if we're worried about where the money is, how much cash we have on hand, this is a really handy summary for us. So it takes numbers from that income statement, from that balance sheet, and it adjusts them. It adjusts the accounting numbers so that we can actually see what it looks like in terms of cash. Where's the money right now? So a cash outflow. So cash outflow, just remember that's cash that's being spent. You're using cash in that case. So it's like a use of cash, or like you can think of it as spending. Money that is maybe an expense. It's money that's going out, right? And your cash inflow is when you it's like a source of cash or money that's coming in. Okay, so these outflows tend to be negative and inflows are positive. You just always think of the direction of the money. If money's coming to me, it's a source of money, that's a positive thing. And if it's going out, that's negative. Okay. And then your overall net cash flows are going to be your cash in minus your cash out, which makes sense, right? So all the money we get positive, so cash inflows. And then we're going to subtract any money that goes away, minus cash outflows. And that'll give us a net cash flow. So we have an idea of where we're at in time. And the cash flows get broken up into 3 main categories. So there's cash flows from operating activities, investing activities, and financing activities. And when we work through Lab 2 together, you're going to have a really good way to practice and see which cash flows fall into which category. Okay, so this is where hopefully, I've said it a couple times now, but it's important to notice the difference though when we're looking at those accounting numbers versus when we're looking at those cash flow numbers. So here it explains that the accountants tend to focus on net income and shareholders focus on net cash flows. And they're not the same, because we could see when we looked at those accounting principles, even though there's a good story and history taking place in our accounting books, it's not always telling us exactly where the money is at a certain point in time, right? So if our revenues and expenses don't actually match in terms of when the money comes in and when the money goes out, it can be a little bit tricky for us when we're trying to figure out how much money is in the company. And so if we want to figure out the cash flows available to, say, investors from operating activities, we have to adjust those actual numbers that we're getting from our income statement, from our balance sheets, from our financial statements, those accounting statements, in order to figure out the cash flows. So here's one formula we can use. So our cash flows from operating activities We take our earnings before interest and tax. We subtract any taxes we have to pay because tax is a cash outflow, right? So that's okay. And then we add back any non-cash expenses. Okay. So this is anything. It can be depreciation for sure, right? So we took out depreciation in our calculations of our income statement, but remember, no cash actually left. So we're going to put that back in so we can make sure we count it as cash. We're going to put back we're going to take out any deferred revenue. So if I have an account receivable, it looks like an asset on my book, but it's actually money that I haven't received yet. So I have to make sure that I adjust for that when I'm doing my cash flows. There's a few adjustments here that we have to make. So that's how we do this part. And like I said, when you get to lab 2, you'll see really how to work through this to create those cash flows. So if we were looking at our manufacturing example and we wanted to calculate cash flows, we can look at this as, okay, so here we have our net sales, cost of goods sold. This is our nice income statement. And we want to get to those cash flows from operating activities. So we'll start off with our earnings. So our earnings before interest and tax. We'll subtract any taxes we paid. And then from there, we're going to add back any depreciation. So we do this one minus this one, and we add back that depreciation expense to figure it out. And it'll look something like this. So there's our formula, and that's how we get to those cash flows from operating activities. Trying to get from my income statement to my overall cash flows is I start with my net income. So that's the profit that I've got in the company. I add back the depreciation expense, and then I have to subtract any accounts receivable changes, inventory changes, current asset changes, accounts payable, or other accrued expenses. And that's because some of these accrual accounts that we have aren't actually changing our cash flow position, right? So we are always worried about how much money we actually have, right? So an increase in inventory, for example, looks like an increase in assets, which is a good thing. But for us, we probably spent some money to increase this inventory. So for us, that's probably a decrease in actual cash or money. And so that's why we have to do all of these little adjustments along the way. I mean, I really encourage you to, when you look at Lab Module 2, you'll get a really better idea of how this all fits together. But just remember that what we're always adjusting for here is we're taking that net income and then we're adjusting it for things that we had in our accounting statements that aren't actually money moving anywhere. So that at the end of the day, we can figure out how much cash we actually have. Okay, cool. Okay, that's it for chapter 2, you guys. So good luck. Good luck with working on the homework problems for this. And hopefully the labs will help kind of clarify also some ways to put some of this stuff into practice. Okay, I'll see you guys in the next video.